Right. Good morning, everyone, and welcome to today's CPD session on transparency reporting. So we're going to be looking at the information from an international perspective of the requirements for audit firms focusing on the ISA-based jurisdictions in terms of communication of what people are doing in terms of their quality management frameworks. What we will also be doing is, from an administrative point of view, what we've got is I'll be running for about an hour. That'll take us to around about on the hour. We will take a 5-minute leg stretch just for you to refresh yourselves. After that, after we've been going for an hour, we will then continue. After that break, we will then have another hour session, which will then take us after 2 hours to sort of about a 10-minute tea break, where you can just sort of go grab yourself a cup of coffee, and then hopefully to finish after running 3 hours. I'm in South Africa, so for me that'll be 12 o'clock midday, but I know we've got people from all around the world, so that's why I'm not going to be using the hour, rather just in terms of minutes and that. So I think that'll just work better for everyone. From a introduction perspective, my name's Edwin Silpst. I do some of the assurance and ethics and related legislation training for W.consulting. So happy to be with you for this morning. And I'm in Johannesburg, South Africa. So hoping you'll be responding on your form in terms of understanding exactly where in the world you're from. This question, and this is what some of you have responded so far. So if you can just scan that QR code, I have also put it in the chat. There's a link there for you to interact with me so that I'm aware of where in the world you're from, and just making sure that I'm talking to my audience. The way this cloud works is that the bigger the font, the more people have responded. So most of you seeming from Riyadh, Singapore, and Johannesburg, and then got some of you from Mauritius, some of you from Windhoek, Hong Kong, Jeddah, Port of Spain, Livingston, Saudi Arabia, Kuala, Durban. So welcome, Cape Town, everybody. Namibia. So thanks very much for your responses. You can keep that going. We've got 175 of you on the session at the moment. So I will be using different QR codes to interact with you. So I'll just keep this up for a while. In terms of the material, I hope you have received the material. I'm just going to move on to the next slide. Give me one moment. Just need to reshare because it wasn't working on the one system. Right, you should be able to see that. That is the, in case you haven't received the material, thanks to W.consulting for uploading it and sharing that QR code with me, so that those of you who haven't got it, you can click on that and then download the material quickly. From the perspective of today's session, so we're going to be looking at understanding transparency reporting. We'll also be looking at the requirements from a number of parts of the world: South Africa, the EU, some countries, New Zealand, Australia, the UK, and if there is a specific area you're interested in, please do let me know and I can try and research that a bit more for you. But I've tried to make this as global as possible. If you do have any questions, please do share them in the chat. I see some people have put in there where they're from: Malta, Kuwait, Cyprus. Appreciate your responses there as well. Please, if we can use the chat for the questions, and if you're giving me responses to questions I'm asking, if you could use that QR code. I'm just going to go have a look and see what's happening in terms of your responses. So at the moment, we've got just under half of you that have responded, and still Singapore. Interesting, 11 of you from Singapore. So welcome everybody, even people from Ukraine, I see, Kiev, Lumpur. So thanks very much for your responses. And we'll be continuing to utilize this sort of technology to be able to interact and for me to get an understanding of how you're familiar with the material, as well as if there's any thing that I haven't explained. Hopefully I'll then be able to address that. So I think in the interest of time, let's continue with the session. I will be watching the chat, so if you do have any questions, please feel free to submit them, and that will then give me an opportunity. I'll address them. I would prefer to take the questions as they arise, because that way we can address them as we're discussing a topic rather than at another stage. I do see a hand up. I think you must rather unmute yourself. Sorry, I think you must rather put your question in the chat, because unfortunately I don't think I'm able to unmute anybody. So if you do have a question, just post it in the chat rather, because this is a big crowd, so I think it'll just work a bit better for everybody. Thanks. Right, so let's then just go back to the material, and let's start the session. Philip, I see you do have your hand raised, so if you could just, I don't know if that's Philip or Philippe. Thank you. If you do have a question, please just post that in the chat. Right, so let's have a look at transparency reporting, and in some jurisdictions this is a bit more developed than others, as we will see. Some of them have legislative requirements, others it's more voluntary, and then the content is also quite varied as to what needs to be included. What we'll be focusing on today is transparency reporting from audit firms in different jurisdictions, and understanding their regulatory requirements, best practice, and some practical implementation and strategies to assist you in producing your transparency reports. The purpose is to equip professionals with the necessary knowledge, technical and other, to satisfy your reporting requirements and to address some of the implementation challenges, and to give you some guidance towards the end of today's session to help you overcome that. And because this is an international course and majority of the world are on the international standards of auditing, we'll look at the transparency frameworks and how internationally they align with the International Standard on Quality Management, ISQM1, in the multiple jurisdictions across the world. And we'll also have a look at some feedback from the regulators in different countries to understand their approach to transparency in terms of maintaining consistency and seeing what is best practice. So when it comes to transparency reporting, we need to make sure that we ensure that we have a proper understanding of what transparency reporting is. So we need to understand what is transparency reporting. And this, to me, is taking the quality management standards and explaining to users of audit reports and potential clients how a firm has inculcated quality in the running of their practice so that there is best governance practices, quality will be at the appropriate standard because of the systems that have been put in place, and allows registered auditors to be publicly accountable to its stakeholders. The core definition of transparency is disclosures around an audit firm's governance structures, quality management systems, independent safeguards, and I think that's an important one because when we look at what's happening internationally, particularly with the audit failures, there is a level of independence that has been compromised, and we'll touch on that in a bit more detail. And then also giving some sort of financial information and metrics and accountability to restore public confidence, which has been somehow diminished in the audit profession because of the corporate collapses. So the first aspect is who must report transparency, and there's different requirements, but ultimately it's firms auditing public interest entities, and we'll have a look at how that differs in different jurisdictions. For example, some jurisdictions say any audit firm that does 100 audits this applies to. So the key focus is on public interest entity auditors because they face the most stringent transparency reporting responsibilities worldwide. And we're going to be discussing how each region requires transparency reports and how this shapes global audit firm behavior. So let's have a look at some of the regulatory drivers around transparency reporting. And in that context, if you're in the EU, there's Article 13, which mandates transparency reports for statutory auditors for auditing firms that audit public interest entities across the EU member states. In terms of the UK, there's the Financial Reporting Council codes that have been established, which requires and oversees the detailed governance and quality disclosures that need to be included in their reports. And in Australia, the Securities and Investment Commission enforces legislative transparency reporting obligations under the Corporations Act. So what I'd like to do now is ask you to please complete the next question, which I'm just double checking is going to come up. So here's the QR code. What is the strongest indicator in your view of a high quality transparency report? You give me one moment. I'm also going to just go out of this and into another thing so I can post it in the chat for those of you that are not able to scan the QR code, but it does seem to be working quite well. So if you can just respond to that, scan that QR code. And while you're doing that, I'm going to just post in the chat the link as well. And you can just click on that. And then this is totally anonymous. So please, just gives me an understanding of your thoughts and helps me to facilitate discussion around what you're thinking with the material that I've prepared and to understand what your views are and thoughts. So while you're doing that, there's your responses so far. So what is the strongest indicator? So I'll let that percolate for a bit, and I'll just continue, and then we'll go back to your responses. So please do continue and submit your views. That would be very interesting to hear. In terms of the ISQM1 Foundation for Transparency Reporting, the global view is that quality operates internally, but it's important that there is a level of communication around what systems one has put in place, because this directly influences the audits that are going to be carried out by a firm or a network. And therefore, this is the the overarching, I should say, influence of transparency reporting. In terms of international standard on quality management, this requires a firm to design, implement, and operate a system of quality management which gives a reasonable level of assurance that the professional responsibilities of the firm will be carried out in terms of meeting those quality standards. And the key components are governance and leadership, demonstrating a commitment to quality, the compliance with the ethical codes applicable in the jurisdictions, be that the IFAC code or a more restrictive version thereof. For example, in South Africa, there are certain enhancements to the code that are in place. There's also quality is influenced by the acceptance and continuance of clients' relationships, and there needs to be proper processes and procedures in place that govern that and need to be enforced. And then engagement performance in terms of compliance with standards, making sure there's adequate oversight of the respective parties. Resource allocation is an important aspect to ensure quality is at the required level, and linked to those resources, be that technological or human capital, they need to be competent for the services that are being conducted. And then the system of quality is only as good as the information and communication thereof, so that people are aware of what needs to be carried out. And unfortunately, like any system, policies are only adhered to if there's somebody policing them. And that's why the monitoring and remediation processes become critical. So we can see how the quality management standards that therefore have a direct impact on quality at a firm, and therefore it's aspects of this that then need to be communicated to the different stakeholders. So this was the responses. So 52% of you have just gone back one side, 52% of you saying the strongest indicator of high quality transparency reports is clear reporting of monitoring and remediation action. And while specific factual disclosures about quality processes are important, that only gives a slight insight into it. Governance by firm leadership will definitely set the tone. But the 48 of you who responded reporting of monitoring and remediation actions, that is communicated by the FRC to say they believe that is the fundamental gauge for transparency reporting in terms of quality, because if there's no cognizance of the changes, the challenges that are being experienced, well, then quality will always suffer. And the objective of a transparency report is to show how the audit firm is engaged in improving quality continually, and therefore monitoring and remediation responses are then critical to ensure that there is adequate and appropriate engagement in and inculcating deficiencies to make sure that quality in future audits will be maintained. So what we're going to be looking at is a global overview based on some of the jurisdictions which publish information publicly. We're going to be looking at the EU, where there's mandatory Article 13 reports, but the information we're going to be discussing is applicable to every single jurisdiction. In terms of Article 13, there is comprehensive disclosures that are required to be produced annually by audit firms in the respective jurisdictions. The UK, which is separate from the EU, their requirements are governed by a framework issued by the Financial Reporting Council of the UK, which looks at the mandatory requirements and compliance expectations, and we'll be looking at those and also looking at some of the metrics that have been disclosed in different parts of the world. Australia has legislative requirements in terms of their Corporations Act, with specific oversight in terms of those requirements. From a South Africa perspective, there is guidance promoting voluntary adoption with mandatory requirements in terms of South African Auditing Practice Standard 7, which then lists an auditor's responsibilities in terms of the compilation of a transparency report. I've always said that when it comes to the auditing standards, an audit is broken up into different phases. You have your phase that deals with planning or acceptance, continuance. It's probably your pre-engagement as well as your planning phase. You then have the execution phase, and you then have the concluding reporting finalization. When it comes to the quality management system, the quality management system to me is taking these aspects, taking an audit methodology and turning it internally to look at the systems that are in place at an audit firm. And what transparency reporting is then communicating what the firm has done in terms of systems and processes to ensure quality will be achieved at all engagements, but the reporting requirements relate to public interest entities, and it's only in the public interest entity space that transparency reporting is of paramount importance. And interestingly, I do believe that it can be utilized as a valuable marketing tool to show what a firm has invested and how committed to quality they are. So the EU transparency reports stem from Article 13, and this highlights that there is an annual publication mandate for audit firms. So all statutory firms and audit firms conducting statutory audits of PIs need to produce a transparency report, and they've even set down a deadline that needs to be published within 4 months of the audit firm's financial year end. The EU, as we will see, is probably one of the most prescriptive requirements in terms of their Article 13, in terms of the scope of that. They also say that governance emphasis is important. There needs to be a proper disclosure of the legal structure and ownership, the arrangements that are put in place around the management of the firm, and a description of the internal quality systems are all required. You know, people say, what is the difference in how a firm is owned in terms of the adherence to quality? And from some of the firms that have collapsed, I'm talking audit firms, it's clearly evident that just like you have audit failures where you have autocratic management, the same is applicable to audit firms, and therefore it's important that there is a proper understanding of the ownership structures. This becomes very important with these discussions happening at the IFAC at the moment around private equity investments in audit firms or networks, particularly with the need to develop significant AI tools to assist and to manage the confidentiality requirements. So all of these factors are critical in terms of understanding what a firm, the risks a firm could be facing, and the pressures that could ultimately drive quality or could, unfortunately, adversely affect it. And from the EU perspective, there's specific requirements around partner rotation, on policies, engagement partner tenure, and making sure that familiarity threats are appropriately addressed. I was in a meeting with a group of academics this week who are in the process of looking at auditor liability and whether or not there's a problem with a model, and they're looking at the models of auditor liability in different jurisdictions around the world. And one thing that came out from our discussion is the familiarity threat is probably the biggest impediment to audit quality. And then what's important is that there needs to be some sort of metrics, financial information, and that can be sort of a turnover divided between audits, non-audits, public interest entity audit fee breakdowns. I'm aware of a regulator in one of the jurisdictions around the world which has to manage audit quality and risk of audit failures, has requested audit firms or audit partners which have signed off in excess of 350 audits in a calendar 12-month period to justify on what basis they were able to do that. And I'm sure this is coming from the use of AI to say, you know, these are the outliers. I've actually got a client who received one of these letters, and fortunate for him, he's got a response that 75% of his audits of however many he had signed off in this period are for, I wouldn't call them quite dormant companies, but non-operating. So you've got literally a loan account and some sort of retained income and a bit of share capital, and you know that's pretty much all that's there. And these are sort of SPVs. So I think there is heightened scrutiny on auditors from the regulator, and this is the auditor's opportunity to tell the story to the stakeholders as to exactly what's happening in terms of managing audit quality. So some of the UK requirements from the Financial Reporting Council is that the transparency report must address the legal structure and ownership, the governance structures, including independent non-executives, which, if you think of it in terms of governance reporting from corporates, this becomes a very interesting concept. Gone are the days when accountants or auditors are best managed or best placed to manage themselves. We know that an independent set of eyes can provide valuable insight into a way in which a business is managed and could be managed and should be managed. And the same is true for audit firms. The internal quality management systems around control and monitoring, because if nobody is evaluating the quality of the audit engagements that are being produced and there aren't appropriate consequences, unfortunately quality slips, and therefore how the firm is managing that is critical to be communicated. And I always say it's great having a strong regulator in your country, but it doesn't help if the first time you identify a problem is when the regulator arrives, because that may be a year to 3 to 5 years later, depending on what cycle, what sort of level of risk you have in terms of the audits you sign off. But in for most of the regulators, where there is a oversight of public interest entities, they're coming around every 1 to 3 years, and therefore it's important that there is proper evaluation and timeous inspection of files and managing risks related to potential quality deficiencies. Independence policies and particular focus on the non-assurance services, the non-audit services, this being significant developments in the code, and therefore it's important to understand how a firm is addressing this, because it also exposes them to potential risk. I was consulting to a firm some time ago, and what transpired is they were highly dependent on non-assurance services, not necessarily to the same firm, to the same clients, but that was area in which they were very strong and focused, and therefore to grow their assurance work was a challenge, particularly where they may have consulted in terms of certain corporates. In terms of quality, if one is not up to date with changes, well, then how is quality going to be maintained? And therefore, it's imperative that there are proper CPD programs, and one reports in terms of some metrics. And late yesterday, I was just focusing on looking at some actual metrics from different jurisdictions around the world. So I'll share that with you in some slides a bit later. In terms of the financial information, so there's revenue breakdown required from firms as well as partner remuneration principles. So one can see that quality is embedded in the remuneration policy to ensure that it's not just about the money that people are chasing. In terms of the UK, so the code says that firms auditing more than 20 listed companies would then have a requirement to make sure that they comply. And the Financial Reporting Council provides guidance on this transparency reporting expectations, and it goes beyond the minimum statutory requirements to promote meaningful disclosures. So the UK, from what I can see, is one of the few jurisdictions that require independent non-executives to sit on the firm's boards or equivalent governed bodies because of that need for that fresh perspective. And then the focus is then more on public interest matters rather than what may be profit motive driven. And this then tries to balance those commercial pressures much better with audit quality. And then what's also critical and evident from the code coming from the UK is the specific disclosure requirements around firm culture, the adherence to ethical behavior, how's that monitored, how's that communicated, and how's that rewarded? Because this is what ultimately drives audit quality. In terms of looking at the legislative requirements from Australia, so there they have something in the Corporations Act. I see there's nobody from Australia here, so I'm going to go through this slightly quicker. But there what we see is that, once again, an annual requirement to make transparency reports publicly available. Also a 4-month deadline. And they a bit narrower understanding or requirement in terms of the quality management standards, because they're just looking at firm network, governance and leadership, the quality control system descriptions, and the independence standards. Not as broad as the UK one. When it comes to South Africa, so from a South African perspective in 2024, there was a auditing practice standard that was issued which governs the auditor's responsibilities. And even though it is called guidance, it is more mandatory through for auditors that prepare or issue reports of public interest entities. And I think, need for these requirements across different jurisdictions is to make sure that there is clear, concise, and consistent reporting around audit quality, which then enables for better comparability if the measures and some of the metrics are the same. While the requirements in South Africa, the detail is voluntary. This allows a firm to be quite flexible, but the disadvantage is then firms will tend to focus on metrics or areas where they have excelled or developed their quality management system, but not necessarily reporting some of the areas which may require further development. In terms of the public interest entity expectations, they're aligned with best practices around the world and demonstrates how a firm is fulfilling their public mandate through the implementation of a system of quality, appropriate governance structures, and maintaining independence. The most recent revisions to the requirements for transparency reporting in South Africa had brought in the global developments and transparency reporting expectations from around the world. When we look at Canada, the reason I've included this is because they have an area which has been heightened, and that is in terms of the inspection insights, which is the area that the majority of you said is critical for which is critical for a high quality audit as transparency report. So what they brought out is that firms increasingly are including the results of the regulator's inspection results and demonstrating how they had taken direct action to respond to those findings and implement adequate and relevant responses in their system of quality management to ensure that there was a focus on improving quality. And the key disclosure areas are no different to what we've seen in terms of the rest of the world. The final area in terms of the second last one I'd like to look at is looking at it from the New Zealand perspective, and they're highly influenced by the Australian markets and also a voluntary adoption with firms reporting in terms of guidance that has been given by the Financial Markets Authority, and then once again alignment to these key areas of quality management. When it comes to Japan, so there the firms also focusing on the quality control systems in terms of producing their transparency reports, the same areas with added focus on the continuing professional education, and this stemming from the results of public interest duties and emphasizing how firms need to balance their commercial objectives with public interest responsibilities in the context of Japan's unique culture. And then the Japanese Institute of Professional Accountants encouraging the adoption of the transparency reporting with the emphasis on the governance structures and audit firm leadership arrangements. So what we see from an international perspective is that there's a balance between mandatory versus voluntary transparency reporting, and the level of detail that needs to be included is also somewhat different, with UK having and Australia having prescriptive mandatory frameworks where a person needs to report, where a firm needs to report, while New Zealand just has oversight and regulation of the voluntary disclosures. What's common in all these jurisdictions is that transparency reporting is there to increase the level of communication about audit quality, to bolster stakeholder confidence and improve accountability and public communication. And the challenges around the different jurisdictions is to making sure that there's a adequate balance between quality and the needs of stakeholders over the information that is being produced, which is often just what the firms are doing good. And regulators will see across jurisdictions have looked at these reports, and some regulators have been issuing surveys around the reports that have been submitted. And, you know, communication there's sometimes it's more marketing orientated rather than quality based. Difficult to locate, or over lengthy, unnecessarily lengthy without meaningful content. So I think there's a lot of, you know, this is a new area for firms to report, and this is an opportunity to make sure that one then addresses these needs that are happening. So if we look at the International Organization of Securities Commission, they play a critical role in promoting the transparency reporting. And these are your stock exchanges around the world, because this is where you have most of the public interest entities and where stakeholders get a lot of their information. And therefore, there is added focus around and recommendation to make sure that auditors focus on the stakeholders, and there's this mandate to protect investors and ensure that there is proper support for the enhancement of audit firm transparency and meaningful disclosures that allow stakeholders, audit committees to engage and then ensure and hold their auditors accountable in terms of maintaining audit quality. Imperative is the consistency of these reports to enable to, firstly, within the same jurisdiction, but then also internationally for audit committees and boards to evaluate the level of adherence to quality to make sure that they can then ensure that there is proper communication and understanding of what's happening in terms of the quality drivers in the firm. And then there needs to be that level of openness to promote the transparency about what happens in an audit firm, because it seems like gone are the days where the users of financial statements and the assurance providers' reports is going to be limited to the audit report alone. Right, I think that brings us to 5 minutes before the hour. So I'm just going to give you a 5-minute refresher. So please, literally, I'll be back in 5 minutes. So just stretch your legs, refocus your eyes, look at the sun if you have any out there. We've got an overcast day here in Johannesburg. But then we'll continue in terms of understanding a bit more of these core components of the quality of the transparency reports. See you just now. Thanks. Right, welcome back, everyone. So what we're going to be looking at now is just to understand the core components in a bit more detail. So when it comes to the legal structure, one needs to understand, thanks, you can lower your hands. One needs to understand these 3 fundamental pillars that stakeholders utilize to have a deeper understanding on what people are looking for. So when it comes to the legal structure, is it incorporated? Is there limited liability? What is the leadership adherence and message around ethical compliance? What is the adherence to the code in terms of independence? What is the level of, for example, rotation? How long do partners work on a particular engagement? If the statutory requirement says 7-year rotation, what is the average number of years? How many partners are there? Because that gives a level of comfort as to, well, how regularly will the partners rotate? Do they have the necessary experience? How long have they been in the industry? And this provides a deeper insight into those independence mechanisms that are put in place to help monitor and achieve quality. When it comes to independence, what procedures are there? Do we have any rotation requirements in terms of statutorily? Are there firm rotation requirements that are applicable? Is there any deeper understanding of the level of non-assurance services that are provided? What is the proportion of that relative to audit fees earned via different organizations? And then in terms of the rotation requirements, are the individuals or the firms being rotated? In South Africa, for example, we have there's been a requirement to disclose audit tenure for public interest entities, how long the firm has been involved. And talk is that there will be legislation introduced to ensure that there will be mandatory audit firm rotation. I'm not here to debate the merits or otherwise of that, but this is one of the independence metrics that is around the world. What's fascinating is I was involved in a forensic investigation, and the audit manager had been appointed as the previous audit year's audit manager took on a financial manager position at a corporate firm. And what transpired is that a fraud took place. What was the most scary result of the settlement that took place is that even though the auditors, through a settlement between 2 weeks before litigation, agreed after apportionment of blame to pay 101 million rand, the condition was that between the parties is that the auditor would continue in the role as auditor of the group. When it comes to the quality management standards, so the inspections, the monitoring, that needs to be aligned to the requirements, and it needs to be operating and being reported on to ensure that there is a continuous drive towards audit quality. The inspection findings we spoke about, particularly coming from, I think it was Canada, which said that one of the key drivers is to inculcate these deficiencies that have been identified in a system of quality management, to understand what the firm is doing to address audit quality. So when we look at governance, structure, and ownership, so we touched on this, there needs to be a clear disclosure of where the money is going. I was consulted to by a medium-sized practice which has a big non-assurance services division, and what was quite fascinating is that when non-RAs are involved, they sometimes don't understand the implications of the quality management standards, and particularly the requirements of the code of ethics, to ensure that there is appropriate governance and adherence to the ethical responsibilities placed on the owners of a practitioner. With these private equity investments in firms, the ownership interest and capital contributions are becoming a bigger focus. There's a firm in South Africa I think it's about 10 years ago now, that collapsed because of a lack of division of ownership. Network affiliations and relationships are becoming increasingly important. I see somebody complaining they're just having a problem with the sound. Not sure if it's my side or yours, but let's just wait to hear if anybody else is experiencing it, because then maybe I need to log in. Maybe if I can suggest, if you are having an issue with the sound, maybe just log off and log in again, and that may, I'm hoping, address the issue. Network affiliations and the relationships between the different firms in your organization. This becomes critical in terms of quality management systems, developing responses to changes in deficiencies that have been identified so that that can be appropriately addressed in terms of your system of quality. And then any unusual ownership arrangements requiring further clarity, because this is where risks stem, this is where undue pressure or influence can be exerted on those signing audit reports, and ultimately could have a negative impact on audit quality, where there are a huge number of stakeholders relying on the reports coming out of audit firms. In terms of leadership responsibilities, there needs to be clear guidance as to how the management of the firm is being conducted, description of those governance bodies, where decision-making authority sits, who has the ability to influence that, and ultimately how is quality overseen. What we've seen is, from an international perspective, where quality is sitting in an independent structure outside of the audit practice, that tends to be of greater authority and ability to influence and drive behavior. To give you a simple and practical example, firms that have the audit quality function sitting within the audit practice, where the often head of quality would then report to the head of assurance, that is a governance misalignment because of the vested interests and the potential risk of intimidation, versus structures where quality is an independent resource or an independent group of people housed within a separate legal entity that reports directly to the CEO. And then information about independent consultative observers or non-executives, independent non-executives. This is providing a huge oversight, and what's been quite interesting is there's been a significant drive over the number of years to have these non-accountants to manage audit firms. And, I remember a number of years ago where this was almost unheard of. How can you have somebody who doesn't understand an audit practice and assurance to run an auditing firm? And the responses were that, yes, but we need to run a firm, we need to run a business, and there needs to be independent oversight. Best practice has also shown that biographical information around these independent non-executives to demonstrate their expertise and their true independence is critical, because that leads to a greater level of confidence in those that are ultimately running the firm. When it comes to independence, so we've got the frameworks that govern what is allowed and what is not, but what's important is how those frameworks are then implemented, how they're monitored, how are threats to independence evaluated. For example, when it comes to partner rotation, how long before partner rotation is there a plan in place to address the risk and manage that so that from the client's perspective, there is a level of consistency and continuity and knowledge, but or should I say that's from the firm's perspective, but from the client's perspective, there is an adherence to these independence requirements. And this would then ultimately include addressing threats such as financial or self-review threats, particularly where you've got employee movements, making sure that familiarity is addressed in terms of if there is a level of continuance, how is that being mitigated in terms of making sure that independence is maintained. And then depending on the corporate structure, depending on the management style of an entity, there may be intimidation threats. I'm aware of the audit firm where the managing partner through proxy was not an auditor and had the majority vote, and there were significant intimidation threats around the area of trying to acquiesce to the audit committee's requests rather than making sure that the auditing standards were complied with. Non-assurance services. So the code is very strict in terms of non-assurance services, particularly in public interest entities, and I encourage you to look at that, or at least attend W.consulting's training in this area. There are thresholds for the amount of non-assurance versus assurance work by individual partners. There's also thresholds for the firm as a whole in terms of assurance versus non-assurance work. In most jurisdictions for public interest entities, that's set at about 15% on the firm level, and on the partner level at 30%. So just, in terms of an understanding of how close a firm is to that, understanding of whether or not the firm's monitoring that appropriately. And then I think the rotation rules, we've discussed in sufficient detail, the partner rotation policies. What's very interesting is the cooling off periods. Some jurisdictions have different rotation requirements from a legislative perspective. And then it's important to look at these requirements to make sure that the cooling off period set by the code is adhered to, because otherwise one may fall foul of the independence standards because the cooling off period hasn't been adhered to. And this would be applicable to engagement partners. There's also a concept of key audit partners. Is anybody ever monitoring that? If there's a rotation requirement, well, is there not a risk then that independence may be compromised, and therefore one needs to develop a system which measures these? And then ultimately succession planning in terms of making sure that quality doesn't suffer where there's a change of management or changes in the audit because of rotation requirements. Not sure if there's any questions. So I think I see there is one. Implement what they have in aviation, accountable management. That's the guy who goes to jail if things go wrong. Sure, that's quite interesting. Thank you. So, yeah, I mean, I think there is that level of responsibility from a quality management system, which is that the CEO or managing partner of an audit firm is ultimately responsible. And that's contained, and I think analogous to what you're saying in the aviation industry, of somebody that has to be the one who is ultimately responsible. And there is they can delegate authority for certain things, but they can't delegate their ultimate responsibility. So, yeah, I think it's an interesting one. So, independence reporting forms a critical component of transparency reports because this demonstrates how the firm safeguards the auditor's objectivity, complies with ethical requirements, and hopefully will then alleviate any financial self-review, intimidation, or advocacy threats. So we've been speaking about the system of quality management. These are the 8 elements in terms of ISQM1. And the system looks at quality objectives and risks, tries to understand where things could go wrong. And then a transparency report needs to focus on how the firm has addressed and incorporated different objectives, mitigated them in terms of certain responses to demonstrating that quality is not being compromised and there are systems and processes in place to achieve quality. The response, the transparency report, is that deeper understanding, that explanation of how the firm has designed and implemented procedures to address these quality risks. So one of these could be, for example, we said critical is incorporating the monitoring findings and understanding how they are used to drive improvements in quality. So this is an example of what should be included in terms of monitoring and the extensive overview of partner quality. Review coverage, the percentage, proportion of engagement partners that have been inspected for quality during the period. The number of monitoring findings, and this could be internal or external or both, across the review programs. And this is a very interesting one, which addresses what we were saying, that critical focus on proper quality is making sure that there's an appropriate remediation rate, understanding how, as a result of findings, what has actually happened, what has transpired, and whether or not there is an appropriate balance for addressing the findings and seeing whether there is appropriate response to audit quality. Sorry, apologies about that. So let's just go on then. Right. So part of the response, as we saw in that previous slide, is what is the remediation rate? What is the response to deficiencies, and how have they identified what the cause of the problem is and then appropriately responded to remove that risk going forward? And that's where a root cause analysis comes in. Categories of root causes to be considered are training. Is there a lack of understanding of the requirements, be they legislative, relating to the code, or in terms of the quality management system? Is there inadequate resources, be that as a result of time, human capital, technology in terms of templates, guidance, or there may be challenges with the entity's culture, and how's that being addressed? That becomes critical. I've seen where there's been mergers. When I was in public practice, I was involved in a firm that went through, I think it was 4 different mergers of varying sizes. And that culture can change significantly. And then methodology. What's important is that firms need to collate this information so that they can report it. Understanding why an issue occurs is a fundamental shift in terms of simply addressing the reason behind quality deficiencies. And root cause analysis is now a critical component in terms of understanding deficiencies, but it's only as good as the data collection and the analysis techniques that have been employed to gather that information, knowing the area in which, or what attributed to which the deficiency is attributable, understanding the frequency and scope of that analysis, and then the governance oversight. I'm aware of a practitioner where the root cause analyses were being carried out by partners. It was submitted to somebody, it was filed, and nothing was actually ever done with it. And some of the findings or responses were that the partner didn't understand what was causing it. Well, if that is a response and level of adherence and understanding of what's detracting from quality, well, how's there ever going to be improvement? And that's why once one has identified the cause, then corrective action can be taken, because then that translates into a measurable, relevant procedure to specifically address systemic quality issues. And best practice transparency reports focus on the discussions around corrective action and making sure that responses are appropriate to addressing these findings. When it comes to external inspection findings, so this is where the regulators around the world, and IFAC summarizes all these reports, but I haven't seen anything in terms of transparency reporting from IFAC. But what's critical is that the disclosure of regulatory inspection results demonstrate the firm's transparency and accountability. And this is what I was alluding to earlier, is that there's different levels of oversight of these transparency reports, whereby the FRC in the UK includes a review of the results of transparency reports and recommends improvements and produces good practice observations. From the Australian side, inspection outcomes are disclosed, recommending improvement and describing proposed remediation that would need to take place. And from a South African perspective, the RBA looks at transparency reports and produces a survey of best practice so that people can focus on what they should be doing in terms of making sure that they adhere and are responsive to regulatory requirements. So here's another QR code for you. If I can ask you to look at this and tell me, in your opinion, what most reduces the usefulness of transparency reports. So what most reduces the usefulness of transparency reports? Too much detail, lack of explanation of inspection findings, describing processes without linking them to outcomes, or lack of concrete examples to illustrate quality improvements. I'm not going to show the results yet that are coming through, but please do submit your responses. Right, let's just, I think it normally works if I just go back to the slides, go one slide forward, and then go back. Right, there we go. So thanks to those of you who have responded. So lack of explanations of inspection findings. So I think we've said that's important to have there. We were discussing that earlier. What's interesting is your responses around describing the processes without linking them to outcomes, because then a firm may have very good systems to address quality, but if there's no link between that and what they're trying to achieve, then not too useful information, unfortunately. And then too much detail about firm ownership. So while that's critical, it's important and a requirement of some of the different jurisdictions, it doesn't become the be-all and end-all. And therefore, that needs to be balanced. And interestingly, 80% of you saying lack of concrete examples to illustrate quality improvements. Which is a very interesting one, because, you can have all these systems and processes, but if you don't show the metrics as to how it's actually translating into improved behavior, into better quality audits being issued, well, then how useful is the system of quality? So, yeah, interesting where you've put your emphasis. I would have had my own focus would have been in a particular area, but I don't think any of these are incorrect. So let's now have a look at, from what we've seen from different jurisdictions around the world, where the focus is and where the deficiencies lie in terms of producing proper audit quality. So in terms of the different approaches between the EU and the UK, while there is legally binding requirements across all member states in the EU, the UK looks at a hybrid approach between statutory requirements from the FRC and governance code expectations. From a content perspective, the EU has directives which specifies required disclosures and elements with limited flexibility. And the advantage there is better consistency and would allow for better comparability. But the detraction of something being more prescriptive is that, if there's something that is useful, then just because it's not required, is that going to be disclosed? And that's why in the UK model, you've got encouraging more extensive disclosure and minimum standards. The EU, some countries have added supplementary requirements, but if your jurisdiction or member state is not one of those, well, are you going to include that information? One should, but there may be a reluctance to do it. What's clear is that if you're playing in the public interest arena, involved in public interest entities, then this is an area of focus that is becoming increasingly important. And when it comes to enforcement, the EU versus the UK, there's a national competent authorities that oversee compliance with varying vigor. So your different audit regulators or the like to look at the level of compliance. Often I've seen this is where sometimes these academia get involved and look at what's happening in the reporting structures of these areas versus having an actual regulator that's reviewing that and publicly commenting on the quality of these transparency reports. Looking at, for example, South Africa versus Australia. So Australia having a legislative, South Africa having a guide, a comprehensive guide with legal mandate, and that approach then allowing more flexibility, but regulation happening in terms of the production of an annual survey by the regulator, which looks at best practice, looks at trends around different metrics even to see what is happening and which is the best way of or which firms in the local jurisdiction are actually producing more valuable and useful information to their respective stakeholders. And then when it comes to Canada and New Zealand, you've got, once again, more voluntary transparency reporting on both sides, increasing guidance with firms demonstrating quality commitment, with inspection result summaries showing how firms have been responsive to the regulatory findings. And the voluntary nature allows for the firm to tailor context to stakeholder needs while maintaining consistent global practices. And a similar model in the New Zealand approach with a framework that emphasizes substance over form, encouraging meaningful disclosure rather than a checklist compliance. When we look at the Asia Pacific regional trends, so looking at those that are evaluating and reporting on transparency. So there's a regional trend towards greater transparency driven by investor expectation, with cross-border capital flows and alignment with the international quality objectives and initiatives. And there, Japan emphasizing governance structures and quality control systems with responsibilities unique to the Japanese model. Singapore looking at, in terms of the Accounting and Corporate Regulatory Authority, encouraging transparency reporting by public interest entities with the adoption of firms aligned with international networks. And then in the ASEAN markets, varied approaches, with some jurisdictions beginning to explore transparency reporting while others maintaining voluntary frameworks. So let's now start looking at some of the more focused audit quality indicators that are being reported in the transparency reports. I think we're approaching a quarter to the next hour. So what I'm going to propose is we just have a look at this slide, and then we will look at some of the other metrics when we look at the independence metrics a bit later. So in terms of audit quality indicators, so leading transparency reports are increasingly incorporating quality indicators that provide a level of insight into the engagement to the extent of the involvement of and resource allocation. What's interesting is looking at, for example, partner to staff ratios. We'll have a look at this in a bit more detail just now, but understanding how many number of partners, so how many numbers of staff does each partner need to ultimately oversee? And, that leads to, obviously, has implications in terms of cost. But what we're more interested in is that the higher that ratio, the less time that a partner would have to exercise their and to just thinking of the right word, to give over their knowledge and expertise and supervision on an engagement. Looking at the average partner hours per engagement, because that has a direct impact on the extent of involvement, but obviously depending on, this could be positive or negative here, because, and that's why it's important that when it comes to these transparency reports, that the discussion is around explaining the numbers. For example, you may have partners that spend on average 40 to 50 hours on an engagement versus another firm that's only got 35. But, is the level of complexity of the PIs the same? Or what is the extent of audit manager involvement and their experience? Because that would have an impact on how involved the partner would need to be. Training hours. Interesting, from this metric, you can see that average partner hours, training hours, and engagement quality reviewer have all increased slightly relative to the previous period. And the engagement quality reviewer, this being a key focus of regulators and a deficiency that's been identified in terms of the implementation of ISQM2, as to, well, if a EQR is required, well, are there adequate resources? Is there adequate budget to ensure that quality is being maintained and will be achieved, rather than just rushing to see to do some sort of a compliance exercise or tick box exercise. Maybe we'll do this one in terms of the independence metrics before we break. We spoke about the non-assurance services. Is one doing this blindly in terms of just performing other consulting work without knowing the implication that this has on the risk of intimidation or objectivity? Looking at the non-assurance services fee cap, we mentioned the 15% cap for public interest clients. But what is the firm's metric? How close are they to that? Are they just skating to meet this because they're managing it very closely? Or is there adequate revenue growth from the assurance services, and therefore this isn't really a big risk in the organization? The level of experience, we spoke about average partner tenure. You can imagine the correlation of average partner tenure versus training hours versus average partner hours. These would all have an impact on each other. And this is where the story that's told about the numbers is critical, because just because somebody has got a is an outlier to the average doesn't necessarily mean it's a negative thing. We know there's a requirement to declare independence. Well, is somebody measuring that? One would expect to see 100% confirmation rate, but that's one thing. I would ask a separate question. Even though 100% have confirmed that they're independent, are there any that have declared? They may have confirmed independence, but may have raised certain concerns. What is the response rate to any potential impairments to independence? And these factors are what gives a level of understanding. Is a firm just doing a compliance exercise, or do they actually understand the risks that they are facing, and how are they actually addressing those risks, and have they got appropriate measures to mitigate those risks? So I think that brings us to an appropriate time to break for I'll give you a slightly longer comfort break. So if I can see you back in, say, 10 minutes, I hope that's okay. So we'll see you in 10 minutes. So that'll be 2 minutes after the hour, and then we'll continue. Thanks. We'll see you just now. Right. So can't see any questions that have come through. So let's then understand what's happening when it comes to the aspect of the culture and ethics transparency. So modern transparency requires reporting about intangible but critical elements of firm culture and how ethical behavior is embedded throughout the organization. The tone at the top, how firm leadership demonstrates commitment to audit quality, to ethical behavior, and to the protection of the public interest. What actions do they carry out to demonstrate this? What decisions do they take that enhances the level of audit quality? What about whistleblowing mechanisms? Disclosures of confidential channels to allow the safety and anonymity of those providing that information, but at the same time ensuring that there's protection policies for them, and an ultimate avenue for which to express their concerns so that one can investigate any potential challenges or breaches of quality or non-compliance to any laws or regulations that may ultimately impact audit quality. Another way is to look at a culture assessment, based on surveys, to get an understanding of what is the underlying feeling within the organization. This can be done by way of interviews, behavioral indicators, or any actions taken to enhance and encourage ethical behavior. And then what is the firm's response to ethical breaches or whistleblowing, and how does the firm address quality failures while recognizing and reward behaviors for demonstrating an adherence to audit excellence? Unfortunately, in a lot of jurisdictions, when it comes to the government area, the public assurance area, this is an area where there is significant failures on the corporate side and in the audit of those institutions as well. I'm aware of a practitioner who signed a non-disclosure agreement as part of a severance pay, not to communicate ethical breaches, matters that this person wasn't happy with, but was unable to disclose, but fully aware that this was happening. So when it comes to stakeholder use of transparency reports, so different stakeholder groups rely on the reports for different purposes. And the primary users of transparency report are audit committees looking to make a better informed decision about a appointment of an auditor, which with the help of transparency reports will enable them to better assess audit quality, to evaluate the systems and processes that are in place at an organization, to understand their adherence to the code and particular focus on monitoring and independence, and what systems there are around measuring and evaluating the auditor's quality. And that would be linked to governance, inspections, both internal and external, and the results there. When it comes to regulators, so regulators review these transparency reports to identify potential risks with quality, looking at whether or not there are any areas of non-compliance, if there's anything that's mandatory, and a determination of where inspection priorities could lie, where risks of non-compliance may be prevalent. Investors, on the other hand, would consult these reports to understand the reliability of the financial information. If a particular auditor is found wanting in the media, being found negligent, well, is that an area for concern? One may want to look at their transparency report post these findings to determine if you're looking to rotate auditors, or if there's any concern around the aspect of audit quality that may be lacking, and it could necessitate a change in auditors. And obviously monitoring results and independent safeguards would be critical. From an academic and from the academia side, there's sometimes a need to analyze these reports to identify trends or best practice, to try and measure regulatory effectiveness, and looking at source data for empirical research in the audit profession. I've got another question here for you, if I can ask you to respond to this. Focusing on audit committees, so what's their use of audit reports, of transparency reports, I should say? I'll give you a moment to respond to that. While you're doing that, I'm just going to see if I can get this, the QR code, and just post this on the chat. I've got 21 responses so far. That's not even 5% of you, so hoping you'll be able to, we can get a slightly better response. I'm going to just post it in the chat, so for those of you where the QR code is not working for whatever reason. So there's it in the chat. You can just click on that and it'll take you to the same question. I'm looking at the responses live. We're up to just 28 of you. So why do audit committees utilize transparency reporting? Right, so this is the response. So thanks to those of you who have communicated and submitted your responses. So most of you saying that it's to understand the firm's culture and quality management system, because that's going to drive who they're going to be utilizing. To evaluate the appropriateness of the engagement partner. So some of you have selected that, at the moment about 14% of you. And what's interesting is, well, that may be very useful information, but sometimes it's not necessarily even identifiable from the transparency report, because it often does not report on specific people. So it's just the firm as a whole. So those of you that sort of responded that it's on the to understand the firm's culture and quality management, I would tend to agree more with that sort of a response. And interesting, to identify audit failures, that would be a very interesting area of research to see what is the level of transparency, and probably post factor after a firm is found to be found wanting, and to see if there's a correlation there. That would be an interesting academic study. But I'm not sure that's the primary reason they would utilize it. But I definitely do think they would try and utilize the transparency reports to avoid potential audit failures where they are concerned about audit quality. So thanks for your interaction. It's greatly appreciated. So let's then continue, and let's have a look at some of these reports. So we've said, in terms of EU, is it required? Yes, these are the different governing bodies, most of them requiring it to be reported annually. What I'd like to look at is the next slide, which you don't have, but this is something I was just looking at last night and thought it was interesting to discuss with you, to understand these different metrics, some of them in terms of the actual information. So Deloitte in the EU, looking at a staff versus partner ratio, 10-1. PwC in the UK, 9 staff per partner. The highest is KPMG in South Africa, 13 employees assurance staff per 1 partner. Now, once again, this is a single metric. It would be important to have a look at this to see, well, what is the language, what is the verbiage around this? In terms of the partner involvement, the highest partner involvement coming in at Australia in this metric at EY, where they've got a 10% partner involvement relative to, I would imagine this is hours for the entire engagement, and that's at a 12-1 staff partner ratio, versus PwC with a 9-1 partner staff ratio being significantly less at 7%. What's concerning is here you've got a 13-1 in KPMG South Africa, a 13-1 partner ratio, but less partner involvement. So that means you don't have much overview or involvement on the audit. And that would be a potentially concerning statistic. When we look at training hours per partner, so looks at about an average of 40 for these 4 that we've listed, with the outliers being KPMG at 35 hours, which translates to what's that, just under a week, versus Deloitte at call it a week and 2 days, and then the others in between. So if we had to look at something just like this, just based on these statistics, Well, it'd be interesting if you can just post in the chat. Who would you choose as auditors here? I know who my favorite would be. Assuming, obviously, these were all in the same jurisdiction, if we can just make that assumption. Assuming they were, who would you choose as your auditors based on these metrics? Any thoughts? Just put it in the chat for me. Okay, we've got quite a few votes for EY. Some saying PwC, some saying Deloitte. So I'm saying if you look at PwC, they've got the lowest staff to partner ratio, highest training, but quite a lowish partner involvement. Does that mean, you're going to have higher costs because you've got more expensive staff? Or, interesting, Deloitte, I mean, they're sitting somewhere in the average in terms of 10-to-1 partner ratio, 8% involvement, which is quite high, and 45 hours of training. So I don't know. I would have potentially gone with Deloitte with this one. If these were the only metrics that we had. But I think we can now have a deeper understanding of how this information can be utilized. But what would be important is to understand, for example, KPMG, for example, maybe they have partners that have got more experience in terms of years, in terms of, and a lot of managers, audit managers in their staff complement, and that may influence you to appoint them as an example. So yeah, thanks very much for your votes in the discussion. There's a comment here that the PwC, the partner involvement is relatively high at 7%, but not too high to potentially save costs. However, partners have a good training, so they might not need to spend too much time. Okay, very interesting. Yeah, nice analogy. So, I suppose my question is always, and that's where the challenge comes, is the training actually, one would hope it is, relevant to the roles that they're servicing, and therefore will translate to better efficiencies, as you're saying. So yeah, no right or wrong answer, but I think it just gives us a deeper understanding of how some of these metrics can be used. So thanks for your response. Sorry, I didn't have Nexia in this. I just used AI to try and collate this information for me. I actually asked for the top 10, but they only gave me these. So now that we've been speaking about the metrics and some of the components, let's understand at the preparation of these reports. And most firms operate on an annual transparency reporting cycle, and that would most commonly be aligned with their financial year ends, and therefore that would require significant planning across multiple firm functions. First phase of any transparency reporting is the data collection, or what I would call the planning stage. There one needs to look at financial analysis, financial information, revenue numbers, governance structures and personnel. That can often be done well in advance, unless there's significant changes happening. And that's probably the area where, unless there's significant findings or risks, that could be pretty standard or set. Monitoring and inspection results, making sure that the results of findings are understood, completed firstly, but then summarized and then reported and understood to drive quality. And remember, we said what's imperative there is looking at those deficiencies and seeing how the system is going to mitigate those findings to ensure quality is improved in the future. Looking at the independence confirmations, but more important, the breaches or the exceptions and how those have been resolved. Collating the information from the resources, the training hours, professional development, looking at quality management system documentation, and then looking at clients and continuance statistics. This is an interesting one. How many clients did the firm take on? What areas were they in? How many proposals did they put out versus how many they took on? How many clients did the firm resign from? And what are the reasons? Because that shows sometimes an adherence to ethical principles. Looking at what are the critical success factors, establishing benchmarks, collating information through consistent information gathering rather than just reporting at year end. Some timeline considerations, 6 months before year end, begin planning, identify content, allocate that to responsible parties, and make sure you have agreed timelines to facilitate your information gathering. 3 months before year end, have a draft outline, understand which data is not available yet, make sure that is being collated and will be in the sufficient detail to be incorporated. And then year end, finalize the statistics or conduct preliminary reviews, and then 2 to 3 months after year end, draft the report, review, approve, and publish the results. With regard then to the preparation of the workflow, what becomes critical is having templates to collate that information, the coordination of essential information to ensure consistency, the necessary level of detail, as well as the message across all sections of the transparency report that one is addressing the needs of that information. When it comes to the quality assurance review, making sure that there is an oversight of the information, reconciling financial information to the underlying records, editorial review, ensuring that there's consistency and readability, as well as some sort of risk management from a legal perspective. Then looking at governance approval, making sure that there is appropriate level of leadership involved in the process, looking at the independent non-executives or somebody with a heightened public interest element focus to make sure that those areas are addressed and can be investigated if additional resources or challenges are identified as early as possible. And then obviously finally, if there is any information, if that can then be published, and then where it's available, communication to stakeholders, and then retention thereof together with the supporting documentation, because remember that is may be reviewed by regulators in the future. I don't know if there's any questions on that. Right, if there's no questions, okay, so then if there's no questions, I think let's move on. So when we look at some of the information coming out of surveys from different regulators on transparency reports, I think it's important when we're drafting this that let's have a look at what those deficiencies are, so that when you're drafting your reports, you can hopefully overcome that immediately. The first is insufficient detail, boilerplate language that fails to explain how the policies actually work in practice. Because this is where there's proper, meaningful understanding of the firm's specific responses to quality management. And if that's lacking, well, it undermines the usefulness of the entire report. What's important is to have a look at changes in circumstances, be that from new initiatives or changes in legislation or risks that have arisen, and updating the system of quality for that, rather than just using the template as a basis for just changing the metrics in the current period. The other risk and deficiency is poor governance disclosures. Looking at the descriptions of governance, is there appropriate decision-making authority? How is audit quality overseen? Is there ultimate responsibility at the highest levels of firm leadership? And finally, the vague monitoring of results in terms of a lack of focusing on meaningful themes, understanding the context in which metrics are being reported, or the explanation of what the firm has learned and how they're responding to the different quality risks. When it comes to the improvement of transparency report, one needs to strengthen that governance reporting, make sure that there's appropriate organizational charts, making sure that there is adequate reporting lines for quality, especially how the oversight bodies look and evaluate quality and hold people accountable. There needs to be appropriate analysis and recording of information to explain the themes in monitoring findings, to get to those root causes, and ultimately to drive the action that is required, and then describe what those remediation efforts entailed. Very useful would be to have year-by-year comparisons with explanations of how one has addressed quality indicators or deficiencies, and then the improvement of specifics, metrics, best work practices, including case studies or an explanation of the information rather than generic terms or common occurrences. So time for you to apply your minds, consider your firm's current governance structures and transparency reporting. Are there any governance weaknesses or gaps that might exist in your firm that could be better addressed or disclosed in your transparency report? Some points to ponder are clarity of decision-making authority. Is that sitting in the right structures? Are the people making those decisions sufficiently informed? What is the independence and effectiveness of oversight mechanisms? I'm aware of a firm where the one practitioner felt that the person in charge of quality wasn't technically up to date, and it undermined the entire system. Critical to balance those commercial versus quality considerations. And then, is there an appropriate explanation to the external stakeholders of the governance structures? When it comes to the aspect of independence documentation, points to ponder are how well are the independent safeguards documented and monitored in your firm? You know, I'm aware of certain practitioners, the only time they look at whether or not there could be any independence breaches or partner rotation infringements is when they're preparing their declaration for their regulator, which is way too late. Look at the completeness of your independence confirmations. Understand what processes there are for employees that join after the deadline. You know, it doesn't help saying, well, they must declare their independence a year later. If they're there a month after the independence declarations were finalized, well, there needs to be a process that they declare that as soon as possible. Are there any threats that have been identified? An interesting one that occurred is there was a audit team member that declared a potential conflict with a particular industry because their parents were involved in the had another entity in the same industry and knew that the firm audited the major competitor and said, well, they had a conflict of interest in this industry, and you know, is there anything that happens with these? The non-audit service approval records, is there evidence that those charged with governance have approved these non-assurance services? Rotation policy compliance tracking, is that investigated and planned? And then, is there any investigation where there have been breaches of independence? When it comes to regulated transparency report weaknesses, focusing on governance sections described as a committee without explaining the composition or who has that ultimate authority. Monitoring results section state reviews were concerned and findings were addressed. Very vague. One needs specifics to understand what was identified, because, well, if this is something that I've got an entity that's of particular concern for me, I want to know that you're aware of it, you're on top of it, and you're addressing it. Important that information is updated for new regulatory requirements rather than using the template as we discussed. Quality management systems needs to be described in specific detail. And then regulator questions whether a firm has actually affect governance oversight of quality. Is the monitoring of quality meaningful, or is it just a checklist exercise? Is independent policies, do they reflect the current requirements? And ultimately, is useful information being communicated to the stakeholders? I saw somebody saying Nexia should be the firm that's going to be appointed. So you're part of a network. Focuses around network challenges is member firms reports very dramatically in length and detail and quality. Sometimes there's over-reliance without a proper understanding of the network systems. It's important that when it comes to quality, that the network inspections and findings are also integrated into the firm's transparency reports. What is the level of the network governance policies, and how is that incorporated in the firm? And what's sometimes been communicated is there's sometimes stakeholder confusion about multinational clients and investors where they read reports from the same firm but in different jurisdictions, and it seems like audit quality is totally different in the different jurisdictions. So these are some of the requirements in different jurisdictions. As we said, most of them, it's all public interest entities. Expected South Africa, because that's the SOPS 7 effective date is 2026, if I'm not mistaken. In terms of the level of detail, what's critical is that most of the jurisdictions probably are just encouraging the inspection results, but the EU, that's dependent on the member state, because there's specific whether or not that's inspected. And there's no real repository, although there are some accounting bodies in different jurisdictions that are collating these transparency reports, and they are quite useful to have them on hand. So in the last 15 minutes, some future trends in transparency reporting. So there seems to be a lot more collaboration amongst the regulators in terms of aligning the requirements of what should be included for different stakeholders. There's a focus on potentially expanding the quality indicators, specific metrics that should be provided by firms in different jurisdictions around the firm's operations, their resource allocations, quality outcomes. So a movement towards standardized audit quality indicators, and then enhanced culture of reporting these transparency measures, extending that to possibly firm culture, ethical climate, behavioral indicators, as well as sustainability matters. Looking at technology and the future of reporting, so AI is the big topic, so one needs to make sure one's using data analytics and AI to facilitate the information, but obviously that comes with its own risks. One needs to make sure that they are appropriately data input driven, and that information, depending on the models that are used or the AI tools, that they are appropriate and reliable. Needs to focus on identifying trends, enable peer benchmarking and comparison, and support that root cause analysis with comprehensive data to justify how audit quality is improved, so that if there are queries, be that from audit committees or regulators, that there is appropriate backup for that information. Looking at from a digital environment, looking at reports that allow stakeholders to explore data at different levels, compared across years or jurisdictions, and then possibility of real-time disclosure, updating for specific metrics as they become available to show improvements in audit quality, to address emerging issues rather than just on an annual basis. When it comes to the stakeholder expectations, so we see that there is investor demands around an understanding of audit quality and reliability in terms of responsible corporate governance, a greater focus demonstrating a adherence to the best practices in the audit industry, audit committee sophistication being improved in terms of the level of interaction between audit committee members and their auditors, and proper assessment and evaluation for auditor selection, and then regulatory scrutiny, ensuring regulators are moving into an oversight role of these reports to utilize the information to assess quality and risks at a particular audit firm or network. And as transparency reporting matures, stakeholders' expectations continue to increase, driving firms towards more meaningful and substantive disclosures. What will happen in terms of climate and sustainability? This is an area we'll have to see what happens in terms of sustainability assurance. Is there quality control processes for sustainability engagements? Because this may be a totally different area. We've got ISAE 5000 that has been issued, which will be the prime standard which is utilized for the conduct of these engagements. And then what's the firm's overall environmental impact and commitment in this regard as well? Likely to be huge stakeholder interest in this area from investors as well as audit committees, and probably a emerging area for quality management in this market as well. And then also focus on regulators understanding whether or not there are specific transparency requirements needed for sustainability assurance practices. When we look at the network versus member firm reporting, so the relationship between network level and member firm transparency reporting continues to evolve as stakeholders seek to understand both the local entity as well as the network's quality management standards. And there needs to be a deeper understanding of what's happening at a network level when it comes to governance policies, methodologies, monitoring programs, but then how that is incorporated and inculcated in the firm's local quality management systems, and then ultimately explained in the firm's transparency reports. And this integration challenge is probably the biggest challenge facing networks. Sometimes there's a lack of understanding, or sometimes as to what and how the resources developed by the network are useful at the entity's level, and other times it's a lack of understanding how these have actually been implemented and how to achieve better quality. So when it comes to the aspect of continuous improvement in culture, so we need to have a learning mindset focused on maintaining knowledge that resonates with the stakeholders, and transparency must be a quality driver, ensuring that the reports and the process strengthens quality, ensuring that there's a systematic review of policies and procedures, there's an identification of gaps and deficiencies, accountability is at the core of improving audit quality, and encouraging leadership focus on specific metrics and trends, and a feedback loop to ensure that the reporting and quality improvement is there. So some key steps for developing and maintaining an effective transparency reporting process: clear ownership and responsibility, create a content framework in terms of the jurisdiction you have and best practice from around the world, and look at what your network is doing, build proper data collection systems, have a proper quality review process of the transparency report, and then monitor the reporting and enhance it to ensure that there is continuous improvement of the reporting and ultimately in the underlying quality of the system. Some common questions to think about is how much detail is required? Well, that depends on your stakeholders. Understand the themes and trends that they're experiencing. Make sure that you respond adequately without compromising confidentiality, but providing specific engagement information, and focus on what firms have learned and how they have improved. In terms of inspection findings, so regulatory oversight and stringency varies, and therefore what is the extent of detail that one needs to go into disclosing these findings, and that will depend on regulatory inspections as well as an understanding of the way in which this information will be used, and therefore focus on themes and significant remediation actions taken rather than specific individuals and findings. But one needs to be sufficiently detailed so it's not too vague. And then ultimately balancing that transparency and confidentiality, while not disclosing confidential information, try and focus on not the who's, not the what's, not the who's, but rather what the firm's done, what's happened, how, rather than who's involved, other than obviously for the accountability. In terms of further learning opportunities, these are some of the information I've used to prepare today's course, that regulatory guidance, look at professional resources coming out of IFAC, coming out of the IAASB, and then start looking at benchmarking, review transparency reports from leading firms in your jurisdiction to identify best practice so that you can see how best to monitor and improve audit quality. So some practical thoughts for developing your transparency reporting plan. Once you've already been through the process once, understanding where your report needs enhancement, what action you're going to take and when, which stakeholders are not being served by your transparency report and how you're going to be addressing that gap, and then what processes or system changes do you need to make to the preparation of the transparency report to make that more effective, and are there any additional resources that you may require? In terms of the transparency report and integrating that with your quality management system, consider designing your reporting requirements when designing your quality management responses and choosing metrics to monitor, looking at the implementation to make sure that the quality management activities are reported transparently and with information that can be captured for later reporting, making sure that there is effective and enhanced opportunities for reporting, and then ultimately monitoring those programs to generate those reports and make sure that the information is meaningful to the different stakeholders. In terms of governance approval process, making sure senior leadership is looking at the accuracy, completeness, consistency, and clarity of the overall findings. And then once the reports have been published, make sure that there's proper communication with stakeholders, there's feedback collection, media monitoring, or as well as internal communication and process review to make sure that the transparency reports are available and being utilized, and then will ultimately be improved as time goes on. So, measuring transparency report impact from clicks on your sites. This could be useful ways to identify whether or not there is appropriate utilization and benefit from your transparency report. And then these are some special considerations for smaller firms, looking at the proportionality principle, ensuring you include metrics relative to your firm size, complexity, and your public interest portfolio, making sure you have adequate resources, looking at the strategic focus and emphasizing the quality of disclosure over quantity, and then looking at collaboration opportunities with some of your peers. If you do have challenges with the communication considerations, one needs to look at significant issues and address those as efficiently and effectively as possible, looking at principles of transparency, context, accountability, action, and learning, and making sure that tone of at the top, where management acknowledges the problems and honestly demonstrate a genuine commitment to remediate them. I've just got 3 more slides and then we'll be done. So apologies for the slight overrun. Looking ahead to the transparency evolution, I think transparency reports will continue to evolve. One needs to look at the current state and make sure that your reports are dealing with that. Focus on where you see user needs, additional information being required, and then start developing those metrics now. In terms of digital innovation, making sure that there is adequate use of technology to enhance the accessibility and the generation of the information, and then making sure there is real-time transparency and integrated reporting is another area to focus on in the future to see how that's going to meet the needs of users. So, course summary, what we've been doing, what we've addressed today is looking at the global framework, making and getting a deeper understanding of transparency reporting and a focus on governance and independence and quality management and how that integrates, looking at reporting to meet stakeholder value and needs, looking at metrics that would be important to them, continuous improvement, and then where the future of transparency reporting is likely to go. That brings us to an end of today's session. I hope that's been meaningful and useful. I'll stay on for a couple of seconds, so until I get if there's any questions. But thanks very much, and hope you've enjoyed the session, and hope to see you at another CPD sorted event. And for those of you in the southern hemisphere, I hope you have a good break, and for those of you in the northern hemisphere, I hope it doesn't get too cold. Thanks everybody, enjoy the rest of your day.